All right, so yet another tax season's right around the corner, and you want to know about all of the tax changes that have come into effect this year. Well, you're in luck. That's what we'll be covering in today's video, looking over marginal tax brackets, registered investment accounts, capital gains, CPP, OAS, and more. So let's not waste any time. Let's get right into it. Okay, let's start off by covering the changes that have been made to our marginal tax brackets, as these will determine both your marginal and average tax rates depending on the income that you're bringing in at the personal level. And of course, for 2025, the Canada Revenue Agency has updated the federal income tax brackets to account for inflation with an indexation increase of 2.7% this year. So it needs to be noted that the tax rates themselves do actually remain unchanged, but the income thresholds for each of these brackets have shifted to look like the following. So on income from $0 to $57,375, you will have a 15% tax rate. Between $57,375 all the way up to $114,750, the marginal tax rate is 20.5%, and then 26% is applied to income between $114,750 all the way up to $177,882. From here, 29% marginal tax rate all the way up to $253,414, and then the top federal tax bracket at 33% this year is for income over $253,414. Now, of course, this only applies to your federal income tax, and depending on the province or territory that you live in, you'll also be subject to income tax brackets for that given province, which have most likely been updated for 2025 as well. So make sure to consult those brackets on your province's website. For sake of example though, an individual earning $120,000 would pay 26% in federal income tax on the amount from $114,750 all the way up to that $120, meaning $1,365 in federal income tax, plus 20.5% is applied on the income from $57,375 to $114,750, meaning $11,762. And then finally, 15% is applied on the income from $0 to $57,375, meaning $8,606, for a total in federal income tax owing of $21,733. However, that would be before other tax deductions, credits, and the basic personal amount, which we'll cover next. So the basic personal amount, or BPA for short, is a non-refundable tax credit available to all Canadian taxpayers. And essentially it represents the amount of income that an individual can earn without being subject to federal income tax. Now, just like with the income tax brackets that we just looked over, this basic personal amount has been increased in 2025 to now be set at $16,129 for taxpayers with a net income of $177,882 or below. Essentially, this means that taxpayers can earn up to that $16,129 without paying federal income tax. And for those earning above this amount, well, the BPA serves as a non-refundable tax credit calculated as follows. So we take that basic personal amount and multiply it by 15%, because that is the tax rate on income between $0 and that $57,000, and this equals a non-refundable tax credit of $2,419.35, right? Because income earned below $57,000 and change is taxed at that 15%. Now, it also needs to be mentioned though that most provinces also have their own BPA, just like their own tax brackets, which will differ from federal amounts. For example, for the 2025 tax year, Alberta's basic personal amount is $21,000, BC's is $12,932, Ontario's is $11,865, and Quebec's is $17,183. Feel free to also pause the video right here to locate your province province or territory. All right, let's now speak about registered investment accounts, which is always one of the most anticipated tax changes every year, with 2025 bringing more of the same changes that we're used to for the TFSA, RRSP, and a couple other accounts. Starting with the TFSA for the 2025 tax year, the annual contribution limit is set once again at $7,000. So this means that if you've been eligible to contribute to a TFSA since its inception in 2009 and have never made a contribution to it, well, your total cumulative contribution room by 2025 would be $103,500. And this total is the sum of annual contribution limits from 2009 through to 2025, which we can see on this chart right here, showcasing each year's allowed contribution room. Also keep in mind that any unused contribution room from previous years where you were aged 18 or older carries forward indefinitely. So not to worry if you have some catching up to do. This means you can contribute more than the annual limit of $7,000 in a given year if you have accumulated contribution room. Moving on to the registered retirement savings plan, or RRSP for short, the 2025 contribution limit has also been updated to allow for a maximum contribution limit of $32,490. Now keep in mind that your RRSP's contribution limit is determined as the lesser of either 18% of your earned income from the previous year or the annual maximum limit, in this case $32,490 for 2025. For sake of example, if you earned $120,000 last tax season, your RRSP's contribution room for the year was set to $21,600, as this is the lesser of those two amounts. For an RRSP contribution limit of $32,490, you would have had to have earned $180,500 or above, and anything above that amount would still only allow you for a maximum contribution room of that $32,490. That being said, a couple of things to remember about the RRSP. If you participate in a company pension plan, your RRSP contribution room is actually reduced by a pension adjustment, which reflects the value of the pension benefit accrued in that previous year. Additionally, unused RRSP contribution room from previous years does carry forward indefinitely as well, allowing you to contribute more in future years if you haven't maximized past contributions. And finally, effective for withdrawals made after April 16th, 2024, the home buyers plan withdrawal limit has actually increased from $35,000 to $60,000. So make sure to mentally note this down if you're planning on buying a home, as this is an amount you can withdraw tax-free from your RRSP. And with this change, first-time home buyers are now allowed to withdraw up to $60,000 from their RRSPs to purchase or build a qualifying home without those immediate tax implications. Next up, the First Home Savings Account, or FHSA for short, is another tax-advantaged account designed to help Canadians save for their first home. Now, there technically haven't been updates to the account, but I wanted to re-summarize it for all of you in case you're looking to purchase a home in the near future. So you can contribute up to $8,000 per year to your FHSA with a total lifetime contribution limit of $40,000. And to be noted, if you don't contribute the full $8,000 in any given year, well, you can carry forward unused contribution room to the following year up to a maximum carry forward of $8,000. So this means that if you contribute less than $8,000 in one year, you can contribute the unused amount in addition to the annual limit in a subsequent year, subject to that lifetime limit. Additionally, contributions to an FHSA are tax deductible, similar to with the RRSP, reducing your taxable income for the year in which the contribution is made. And what's even better is that withdrawals are tax-free also, like the TFSA. So if you're truly someone who's looking to buy a home in the upcoming few years, this is probably going to be your best registered investment account to take advantage of. All right, moving on out of the registered investment accounts, we need to cover the increase in the capital gains inclusion rate, which isn't necessarily new for 2025. However, it's a newer tax rule overall that will impact Canadians moving forward. so it needs to be mentioned in today's video. All right, so effective June 25th, 2024, the capital gains inclusion rate increased from 50% to 66.67% for gains realized after this date. And this change affects both individuals as well as corporations, particularly those with gains exceeding $250,000 in the year. Now, when this was announced in mid-2024, people were pretty outraged, which is completely normal, claiming that we already pay enough taxes in Canada and that going after capital gains, which is usually achieved through business investments, isn't the right course of action to promote business and innovation in the country. But yeah, so the way these changes work is that for individuals, the increased inclusion rate applies only to the portion of annual capital gains that exceed $250,000. So for sake of example here, let's say you sell an investment property for a capital gain of $500,000. Well, only 50% of the first $250,000 of the capital gain will be added to your taxable income. And then for the other $250,000 slice from this example, 66.67% of it is included, meaning $166,675 for a total of $291,675 of that capital gain now being added to your taxable income instead of only $250,000 as it were previously. So essentially, in typical Canadian fashion, if you do well on an investment, well, now you're paying even more taxes than you were already. And for Canadian corporations, there is no first $250,000 limit. They're subject to 66.67% inclusion rate on the entirety of the capital gain. The next topic we'll be covering is CPP and OAS. So the Canadian Pension Plan and Old Age Security. So the CPP is undergoing enhancements to increase retirement benefits for Canadians with key changes for 2025, including the following. Increased contribution limits where the maximum pensionable earnings under the CPP will now rise to $71,300 in 2025, up from $68,500 in 2024. Consequently, the maximum annual contribution for employees and employers will increase to $4,034.10 each, up from $3,867.50 in 2024. And then of course for self-employed individuals, we will see their maximum contribution rise to $8,068.20. Additionally, there's the introduction of a second earnings ceiling. So in 2024, a secondary earnings ceiling was introduced, set approximately 7% higher than the first earnings ceiling. But in 2025, this second ceiling will be approximately 14% higher, where employees earning above the first ceiling will make additional CPP contributions on income between the first and second ceilings. These contributions are calculated at 4% of the income within this range, with employers matching this contribution as well. Now, the Old Age Security Program has also made some adjustments affecting higher income retirees. Essentially, in 2025, the OAS clawback, officially known as the OAS recovery tax, begins when individuals' net income exceeds $90,997, where OAS benefits are fully clawed back at an income of $148,451 for individuals aged 65 to 74 and at $154,196 for those aged 75 and above. So this means that higher income seniors may see a reduction or even full elimination of their OAS benefits if their income surpasses these thresholds. Make sure to plan accordingly if this might affect you. All right, and finally, let's cover EI payments. As for the 2025 tax year, the Canadian Employment Insurance EI program has implemented several key changes as well. First off, the employee premium rate is now set at $1.64 per $100 of insurable earnings, a slight decrease actually from the 2024 rate of $1.66. However, employers contribute $2.30 per $100 of insurable earnings, and the cap on earnings subject to EI premiums increases to $65,700 in 2025, up from $63,200 in 2024. What's more is that the the maximum weekly benefit rate rises to $695, up from $668 in 2024, and the maximum weekly benefit for extended parental benefits increases to $417. That said, if you're a resident of Quebec, the employee premium rate is $1.31 per $100 of insurable earnings, with employers contributing $1.83. Finally, for employees earning at or above the maximum insurable earnings, the EI premium will be $1,077.48, which is an increase from $1,049.12. All right, so that covers the main changes to Canadian taxes for 2025. If this video helped you out, please consider clicking on the like button and subscribing for more tax and investment related topics. Plus, if you want to learn more about how you can lower your tax bill this season, make sure to check out one of these two videos right here. Thanks a lot for watching, and I'll see you in the next one.